Imagine discovering that the portfolio manager handling your entire retirement fund just, received a highly lucrative, all-expenses-paid trip from a company they are actively recommending you invest in.
Yeah, that would definitely sound some alarm bells for most people.
Right. Or perhaps you find out that an analyst uncovered a massive structural flaw in a publicly traded company. But instead of adjusting their public recommendation, they just quietly informed a few select high net worth clients to sell off the stock before the news broke to the rest of the market.
Which obviously leaves everyone else holding the bag.
Exactly. Your immediate reaction to both of those scenarios is probably just outrage. You would feel cheated. I mean, you'd naturally assume a crime had been committed.
Oh, absolutely. You'd be looking for the handcuffs.
But when you step into the complex, hyper-connected world of global finance, the line between a federal crime and a perfectly legal, albeit highly questionable business practice is often razor thin. We trust the financial system sort of like we trust the foundation of a 100-story skyscraper.
We just assume the engineering is sound.
Right. We assume the concrete is poured correctly and it will hold our weight. But the foundation of the global economy isn't made of concrete. It is made entirely of human judgment.
It really is. It's the ultimate invisible architecture. I mean, the global capital markets process trillions of dollars, they dictate the growth of entire nations, and they secure the future of individual citizens, all based on this underlying assumption of structural integrity.
And that integrity doesn't just, you know, spontaneously manifest.
No, not at all. Just because we have markets and algorithms doesn't mean things are fair. That integrity has to be actively constructed and relentlessly maintained. So our mission today is to examine the exact blueprints of that architecture. We are unpacking a foundational text from the investment industry specifically, excerpts from a learning module on the CFA Institute's Code of Ethics and Standards of Professional Conduct.
Now, if you are listening to this, you might not be a financial analyst. You might not spend your days building valuation models or executing high-frequency trades. But this material dictates the behavior of the professionals who do.
Exactly. These are the rules governing the people who manage your savings, structure your pension, and drive the global markets.
Even if you never trade a single share of stock directly, you are a participant in this ecosystem. Understanding the psychological and philosophical framework detailed in this text gives you the vocabulary to know exactly what to expect and what to demand from the institutions handling your wealth.
It empowers you as a consumer and a participant.
So, okay, let's unpack this, because what we have here is absolutely not some dry boilerplate compliance manual. It is this profound exploration of human behavior in environments where money, temptation, and immense responsibility are just constantly colliding.
It really is fascinating, and the text establishes its core premise immediately, right on page 1, by addressing a very dangerous misconception. It draws a massive, uncompromising boundary between what is legal and what is ethical.
Because in common conversation, we tend to use those concepts interchangeably, don't we?
We do. The assumption is usually that if a behavior complies with the law, it must inherently be the correct way to act. But the module completely shatters that assumption. It defines legal behavior as simply what is required by a governing body.
Right.
But ethical behavior is defined as conduct that is morally correct. They are not the same thing. And operating under the assumption that they are is, well, it's the root cause of massive systemic failure.
Yeah, I look at it like a speed limit sign on a winding road. The law is the absolute bare minimum standard of acceptable behavior.
That's a great way to put it.
So the law dictates that the speed limit is 35 miles per hour. That is the regulatory requirement. If you drive 35 miles per hour, you are legally compliant. But if it is pouring rain, the road is slick, visibility is terrible, and, there are kids playing nearby, the ethical decision is to drive 15 miles per hour.
Right, because the law provides a fixed, rigid boundary, but ethics requires situational judgment applied on top of that boundary.
Exactly. If an investment professional is navigating the market looking solely at the speed limit signs, they're eventually going to cause a catastrophic crash.
And that analogy perfectly illustrates the text's argument regarding the insufficiency of regulatory compliance frameworks. A firm cannot simply hand its employees a list of laws and say, okay, we have an ethical culture now. The source material outlines 2 distinct reasons why relying solely on regulators is a failed strategy.
What's the first one?
Well, the first is just a matter of sheer logistics. Regulators fundamentally lack the resources to enforce rules constantly. I mean, think about it. The financial markets process millions of complex transactions every single day, spanning dozens of global jurisdictions.
It's massive.
There is no regulatory body on Earth equipped with the manpower, the technology, or the funding to monitor every single action in real time with perfect clarity. Going back to your analogy, there just aren't enough police cars to monitor every driver on every road at all hours of the day.
So the structural implication there is that the system operates largely on an honor system until something breaks. The regulators are reactive, not proactive.
Precisely. They show up to investigate the wreckage after the crash has already happened.
Wow. And what's the second reason?
The second reason the text cites for the inadequacy of the law is human nature itself. The text explicitly notes that some individuals will inevitably succeed at finding ways to circumvent regulatory rules for their personal gain.
Because laws are inherently rigid. They're written to address the problems of the past, right?
Exactly. But financial markets are infinitely creative. As soon as a law is written to close a loophole, highly incentivized individuals will engineer a new financial instrument or maybe a new routing strategy that technically complies with the letter of the law while completely violating its spirit. Laws attempt to guide behavior, but they just cannot comprehensively cover all unethical behavior.
The text actually uses a phrase that really anchors this entire philosophy. It says, ethical principles go beyond that which is legally sufficient.
That's the core of it, yeah.
Because if a portfolio manager or an analyst is constantly asking their legal department, is this legally sufficient? Or will I go to jail for this? They are already failing the ethical test.
Oh, absolutely. The financial industry is built entirely out of gray areas, edge cases, and unprecedented scenarios. If your only internal compass is the fear of prosecution, you are entirely unarmed when you face a dilemma that the law hasn't anticipated yet.
Which forces us to ask a pretty critical question. If the law is insufficient and regulators are fundamentally under-resourced, what is actually preventing the global economy from devolving into just a predatory free-for-all?
Well, the text argues that the only viable solution is the development of an internalized framework for decision-making at both the individual and the firm level. It requires shifting the default mode of operation. You see, most investment professionals are trained to view the world through a singular lens, the business outlook.
Right, they evaluate scenarios based almost entirely on a profit and loss perspective.
Yeah, exactly.
And, I mean, we shouldn't pretend that maximizing profit and minimizing loss isn't the core function of their job. They are hired to generate returns for you. But the text makes it clear that the profit and loss lens cannot be the only one they use.
It can't be, because gathering information from various sources, developing investment recommendations, managing assets for disparate clients, these daily actions constantly generate conflicting interests.
So if an analyst only looks at the profit and loss metric, they will eventually encounter a scenario where the most profitable action for themselves or their firm directly harms their client or damages the integrity of the market.
That's the danger. They have to superimpose an ethical perspective over the business perspective. Which brings us to the real challenge, implementation. A firm can recognize this need, they can hire consultants, and draft a beautiful, comprehensive code of ethics. But the text explicitly warns against the illusion of the dusty compilation.
The dusty compilation, I love that term.
Right. A code of ethics that lives in a binder on a shelf, or exists as a PDF that new employees sign on their first day and never look at again. It's entirely useless. It risks becoming an ignored artifact if it is not woven into the actual fabric of the firm's operations. Transforming a set of written principles from a mere compliance exercise into the beating heart of a firm's culture, that is the true challenge of leadership.
But how does a firm actually accomplish that? I mean, every financial institution claims to have a sterling culture of integrity. Nobody puts, we prioritize short-term profit over client well-being in their marketing materials.
No, definitely not. But the module identifies one specific element as the paramount driver of firm culture. It asserts that the development, maintenance, and demonstration of a strong culture of integrity by senior management may be the single most important factor in promoting ethical behavior among the firm's employees. It operates on the principle of institutional gravity.
Behavior flows downward. So if the managing director is constantly walking right up to the line of what is, legally sufficient, or if they're looking the other way when a top-performing trader cuts corners on their research paper, All the ethics training in the world won't stop the junior analysts from adopting the exact same behavior.
The unwritten rules of the office will always override that dusty compilation in the binder.
Yeah. And that dynamic ties into one of the most compelling analogies in the source material. The text compares the development of ethical decision-making to the physical training required for running. It states that a natural inclination to do the right thing is insufficient in the complex world of finance.
Which is a powerful statement.
It is, but I want to push back on that a bit because it sounds counterintuitive to how we generally view morality.
Hmm.
We tend to think of ethics as an inherent character trait. You are either a fundamentally honest person or you aren't.
Right, that's the common perception.
So why isn't a natural inclination to do right enough? If someone has a strong moral compass, why do they need to practice not lying or not stealing? It feels like we are overcomplicating common sense, doesn't it?
It does feel that way initially, but it is a vital distinction, and the running analogy clarifies it perfectly. Look, almost anyone possesses the natural mechanical ability to run across a field,
Sure.
but that natural ability does not equip you to run a marathon. To run a marathon, you need coaching, you need technique, and most importantly, you need endurance. The text argues that the financial industry is an ethical marathon filled with structural obstacles. Investment managers need to practice ethical decision-making to develop muscle memory.
Muscle memory for ethics.
Yes, they have to train for the moments when they face incredibly difficult issues and severe conflicts of interest.
Okay, that makes sense. The text points to situational influences as the primary reason this muscle memory is required. Basically, a fundamentally good person can be placed in a system that exerts immense invisible pressure on their judgment.
Oh, absolutely. And the most prominent example given in the text is corporate compensation strategies. Think about it, if an analyst's year-end bonus, which might constitute the vast majority of their total income, is tied strictly to the short-term yield of the assets they manage, that compensation structure is a massive situational influence.
It actively incentivizes them to take on hidden risks.
Exactly, to ignore long-term stability and to push boundaries. The system actively tests their natural inclination to do right. Furthermore, the text highlights the reality of decision fatigue in an environment where choices are rarely unambiguously right or wrong.
Right, because the modern investment professional is making dozens of high-stakes calculations a day. If you haven't built up ethical endurance through practice and a strong, firm culture, the situational influences will inevitably overpower the best of intentions.
It will. The most dangerous compromises aren't cartoonish acts of villainy.
Right, nobody is twirling their mustache.
Exactly. They are incremental. They are tiny, ambiguous decisions where the easiest, most profitable path is just slightly less ethical than the alternative. Over time, without that muscle memory, an individual will default to the path of least resistance.
So we've established the philosophical foundation. We understand that the law is insufficient, that situational influences warp human judgment, and that professionals must develop ethical muscle memory. But what exactly are the specific movements they are practicing?
That brings us to the operational blueprint laid out by the CFA Institute, a framework that the text notes has been continually evolving for over 60 years to keep pace with the market. It is divided into two distinct interconnected halves, the Code of Ethics and the Standards of Professional Conduct.
And the distinction between those two halves is critical for understanding how the whole framework functions. The Code of Ethics is designed as a set of broad principles, right?
Yes. It defines the overarching aspirational conduct expected from members. It is the philosophical North Star. It establishes the mindset that must precede any specific action.
Looking through the practice problems that accompany the text, one specific detail regarding the code stands out as remarkably profound to me. The code explicitly demands that members promote the integrity and viability of the global capital markets, not simply to ensure fair trading or to protect their firm's reputation, but for the ultimate benefit of society.
That phrasing is intentional and very powerful.
What's fascinating here is that specific phrasing elevates the entire industry. The general public often views global finance as an inherently selfish pursuit, a closed loop of wealth generation for the already wealthy. But the code structurally frames properly functioning capital markets as a foundational pillar of societal well-being.
It explicitly connects the microactions of the individual analyst to the macro health of the global population. Ethics, sustainability, and market integrity are presented as components of the exact same concept, protecting the best interests of all.
Because if capital markets are corrupt, if the pricing of assets is fundamentally manipulated, the ability of companies to raise capital for innovation just ceases.
Exactly. The value of retirement funds collapses. and the economic engine of society stalls. The code demands that the investment professional view themselves as a steward of that engine.
That is the overarching principle. But aspirational principles need teeth to be effective. That is where the second half of the framework comes in. The standards of professional conduct outline the actual granular behavior that constitutes fair and ethical business practices.
If the code is the philosophy, the standards are the physics. And the text notes that the investment world has become exponentially more complex since this handbook was first published. The core principles of distinguishing right from wrong do not change, but the application of those principles in a world defined by algorithmic models, high-frequency trading, and complex derivatives that requires constant revision.
Right, the CFA Institute periodically updates both the code and the standards to remain relevant to the evolving nature of the investment profession. So, to truly understand how this architecture holds up under pressure, let's dive into the specific scenarios these professionals face daily. The text categorizes these rules into sections, starting with the absolute baseline of systemic integrity, Standard 4 and Standard 2.
Yes. These address the relationship between the professional, the law, and the market as a whole. Standard first is titled Professionalism, and it begins with knowledge of the law. Members must understand and comply with all applicable laws, rules, and regulations of any government, regulatory organization, licensing agency, or professional association governing their professional activities.
That seems pretty straightforward, until you introduce the reality of a globalized economy.
Precisely.
This global aspect is where the framework really proves its strengths. I mean, imagine a multinational firm. You have an analyst sitting in London, executing a trade on an exchange in Tokyo on behalf of a client located in New York.
A very common scenario.
They are simultaneously subject to the laws of the UK, the regulations of the Japanese exchange, the laws of the United States, and the internal policies of their firm. So what happens when those rules conflict? What happens when a specific trading practice is perfectly legal in Tokyo, but highly restricted in New York?
This is a scenario ripe for regulatory arbitrage. That's where a firm might route operations through jurisdictions with the weakest oversight specifically to maximize profit. But Standard IA completely neutralizes that incentive. It dictates that in the event of a conflict between any of these laws, or between a law and the CFA Institute's code and standards, members must comply with the strictest law, rule, or regulation.
Here's where it gets really interesting, because that is a staggering requirement. It means you cannot hunt for loopholes.
Nope, you can't.
If the local law in a foreign jurisdiction permits a behavior, but the code of ethics forbids it, the professional must follow the code. They must actively defer to the highest possible standard of conduct, regardless of where they are physically located or where the trade is executed.
It forces a universal ceiling on behavior, rather than allowing a race to the bottom. It entirely removes the defense of, well, it was legal where I did it.
Wow.
Standard also addresses independence and objectivity. Professionals must not offer, solicit, or accept any gift, benefit, compensation, or consideration that reasonably could be expected to compromise their own or another's independence and objectivity. This directly targets the situational influences we discussed earlier.
It addresses the slow, insidious corruption of judgment. Because a corporation isn't necessarily going to hand an analyst a briefcase full of cash to upgrade their stock rating.
Right, that's too obvious.
But they might invite that analyst to an exclusive week-long corporate retreat at a luxury resort. The psychological pressure of reciprocity is immense. If you accept the lavish gift, your objectivity regarding that company is fundamentally compromised, whether you consciously realize it or not.
You feel like you owe them something.
Exactly. And the standard requires the professional to recognize and reject those subtle mechanisms of influence.
Moving from the independence of the individual to the integrity of the system itself, we encounter standard integrity of capital markets. This encompasses the severe violations that typically make international headlines, specifically material non-public information and market manipulation.
Insider trading.
Yes. Standard 2. The text dictates that members who possess material non-public information that could affect the value of an investment must not act or cause others to act on the information.
Now, the phrase "must not act" is obvious. You cannot learn confidential information about a pending merger and go buy the stock yourself before the public finds out. But the practice problems provided in the text explore a much more nuanced scenario.
They do. The practice problems are designed to test the boundaries of the rule. Consider a scenario where an analyst uncovers material non-public information. They know they cannot trade on it for their own portfolio. They know they cannot use it to trade for their firm. But what if they simply mention it to a friend over dinner?
Just a casual conversation.
Right. they don't make a single dime from the information. They execute zero trades. Have they violated the standard?
Based on the text solution, it is unequivocal.
Yeah.
Yes. The prohibition explicitly states you must not act or cause others to act.
That's the key phrase.
Passing a tip to a friend or heavily implying to a family member that they should adjust their portfolio based on information.
Mm.
But the market doesn't. That is a massive violation. It initiates a cascading chain of market distortion. The fact that your own hands never touched a keyboard to execute the trade is irrelevant. You are the catalyst.
Exactly. You have breached the integrity of the pricing mechanism. And preserving that pricing mechanism is the core focus of standard IEB, market manipulation. The rule prohibits engaging in practices that distort prices or artificially inflate trading volume with the intent to mislead market participants.
This speaks directly to the mechanics of trust. The market relies on price as a signal of value and volumes as a signal of demand. So if an entity engages in wash trading, simultaneously buying and selling the same financial instrument back and forth between affiliated accounts, they create the illusion of massive market interest.
Other investors see the volume, assume there's legitimate momentum, and buy in,
driving the price up based entirely on a mirage. The standard prohibits weaponizing the mechanics of the market against other participants.
Now, protecting the macro environment of the market is crucial, but the text makes it explicitly clear that the foundational anchor of the entire profession is the micro relationship between the professional and the individual client. Standard 3. Duties to clients outlines the sacred nature of the fiduciary relationship. It is categorized into loyalty, prudence, care, and fair dealing.
The mandate of loyalty is uncompromising. Members have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Most importantly, they must place their clients' interests before their employer's interests or their own. In any scenario where incentives conflict, the client must win. Always.
Always. And the application of that loyalty is detailed in Standard 3C. Suitability.
Suitability is a big one.
It is, because the concept of suitability is not about finding a quote-unquote good investment. It is about finding the right investment for a specific entity. Before taking any investment action, professionals must make a reasonable inquiry into a client's investment experience, their risk and return objectives, and their financial constraints.
Because you cannot manage money in a vacuum. You cannot assume that a product offering high returns is automatically a good fit. You have to understand the client's liquidity needs.
Absolutely. Are they retiring in 2 years or 30 years? Do they have massive tax liabilities? What is their psychological tolerance for watching their portfolio drop 20% in a month?
And the text dictates that this cannot be a one-time conversation.
Right. The professional must reassess this profile regularly because a client's life and therefore their constraints constantly change. But the most intellectually demanding aspect of this standard is how it mandates the evaluation of risk. The text specifies that members must judge the suitability of investments in the context of the client's total portfolio.
The total portfolio requirement is fascinating because it forces a holistic perspective. Let's look at the mechanics of that. Imagine an incredibly exotic, highly volatile derivative. If an advisor evaluates that asset in isolation, it appears phenomenally risky.
Terribly risky.
Right, so if they advise a client to put their entire life savings into that single asset, they've committed a severe ethical breach. It's objectively unsuitable.
However, the analysis changes entirely when viewed through the lens of the total portfolio. Imagine that same client holds a massive portfolio consisting almost entirely of highly conservative, low-yield government bonds. Their primary risk isn't market volatility. Their primary risk is that inflation outpaces their low returns. In that specific context, recommending that the client allocate 2% of their wealth into that highly volatile, high-yield derivative might be the exact correct maneuver to balance the portfolio's overall risk profile.
Oh, wow. So an asset that is wildly unsuitable in isolation becomes perfectly suitable when utilized as a calculated counterbalance within a larger structure.
Exactly. The standard prevents the professional from being intellectually lazy. They cannot just label an asset good or bad. They have to do the complex math of correlation and total risk exposure.
That level of care must be applied across the entire client base, which leads to a common point of friction addressed in Standard 3. Fair dealing. Members must deal fairly and objectively with all clients when providing investment analysis, making recommendations, taking investment action, or engaging in other professional activities.
Yes, fair dealing.
But this is an area where the definition of words matters immensely. Does dealing fairly mandate dealing equally? Because if I am an advisor and I have one client who has invested $10,000 with me and another client who has invested $10 million, am I required to provide them with the exact same level of service?
It's a great question.
The reality of the business world is that the $10 million client pays exponentially more in fees.
And the text anticipates this exact confusion. It specifies dealing fairly and objectively, but it does not mandate equal service levels across all aspects of the business relationship. A firm might offer the high net worth client access to exclusive reporting, dedicated administrative support, or more frequent face-to-face meetings. That is permissible.
So where's the line drawn?
Where the strict line is drawn is in the core professional services of analysis and investment action. The execution of the strategy must be blind to the size of the account.
Ah, I see. So if an analyst realizes their valuation model is flawed and decides to downgrade a stock from a buy to a sell, they cannot call their wealthiest client first, allowing them to exit their position before the market reacts, and then systematically notify the smaller clients hours or days later.
Exactly. The distribution of that recommendation, the opportunity to act on the professional insight, must be objectively fair. You cannot weaponize time to play favorites.
Moving forward, Standard 3 covers the preservation of confidentiality. Trust cannot exist without discretion. Members must keep information about current, former, and prospective clients confidential. The practice problems highlight the specific exceptions to this rule, though.
Right, there are always exceptions.
Confidentiality must be maintained unless the information concerns illegal activities on the part of the client, disclosures required by law, or the client explicitly permits disclosure.
So the client is the anchor, but the professional does not operate as an island. They are integrated into a larger ecosystem, which brings us to the duties they owe to their firm and to the integrity of the data itself. Sections 4, V, and 6 of the standards map out the ethical requirements of analysis and the management of unavoidable conflicts.
Standard 4 covers duties to employers. It requires that members act for the benefit of their employer and not deprive their employer of the advantage of their skills and abilities, divulge confidential information, or otherwise cause harm. It basically establishes that accepting compensation from an entity creates a binding obligation of effort and loyalty.
Provided that loyalty doesn't conflict with the paramount duty to the client.
Right, the client always comes first. But Standard V investment analysis, recommendations, and actions is where the intellectual rigor of the profession is truly tested. Standard VA requires members to exercise diligence, independence, and thoroughness in analyzing investments. They must have a reasonable and adequate basis supported by appropriate research and investigation for any recommendation.
You cannot rely on rumors. You cannot copy another analyst's work without attribution. And you certainly cannot just guess.
The application of this diligence is further refined in Standard V, which governs communication with clients. Members must distinguish between fact and opinion in the presentation of investment analysis and recommendations. And in the high-pressure environment of financial sales, this is an incredibly difficult boundary to maintain.
Think about the psychology of the pitch.
Yeah, exactly. An analyst has spent months building a valuation model for a company. They believe in their thesis. When they communicate that thesis to a client, the natural human inclination is to present their conclusion as an absolute certainty to inspire confidence.
Because they want to sell the idea.
Right. The line between stating a fact such as, this company generated $1 billion in free cash flow last quarter, and stating an opinion such as, this company will dominate the market sector for the next decade, easily blurs when the goal is to drive investment action.
It does. And the standard forces the professional to constantly deconstruct their own rhetoric. They must clearly identify what is historical data and what is a forward-looking projection. The practice problems detail an implicit requirement of this standard that is deeply relevant today. Given the constant development of new, exotic financial instruments and highly complex trading strategies, members must disclose to clients the specific risks and limitations of the recommendations being made.
So if a firm is pitching a brand new algorithm-driven derivative, they might have years of backtested data showing incredible returns. Presenting that backtested data as a guarantee of future performance is an ethical failure.
Complete failure.
The professional must clearly articulate, this data is factual history, but our belief that it will continue to work in a shifting market is an opinion. And here are the precise limitations of our model and the ways this strategy could catastrophically fail. They have to actively map out the downside for you.
And to ensure accountability for that analysis, Standard VC requires record retention. Members must develop and maintain appropriate records to support their investment analyses, recommendations, and actions.
So if an inquiry is launched regarding why a specific trade was made 3 years ago, the professional must be able to produce the mathematical and analytical foundation for that decision. They must be able to prove the work.
You have to show your math. Which leads us to the final major pillar of the framework, Standard 6, conflicts of interest. The text operates on the realistic assumption that conflicts of interest are entirely unavoidable in the financial industry. You cannot eliminate them.
They're just part of the business.
Exactly. Therefore, you must manage them through transparency. Standard VAA requires full and fair disclosure of all matters that could reasonably be expected to impair independence and objectivity or interfere with respective duties to clients, prospective clients, and employer.
And the text dictates the manner of this disclosure, right? It must be prominent, it must be delivered in plain language, and it must communicate the relevant information effectively.
You can't hide it.
Right. A firm cannot bury a conflict of interest on page 80 of a prospectus in microscopic font, surrounded by dense legal jargon, and claim they have fulfilled their ethical obligation. The disclosure must actually inform the client, not just shield the firm from liability.
Standard VIB addresses priority of transactions, which serves as the ultimate operational test of loyalty. It states that investment transactions for clients and employers must have priority over investment transactions in which a member or candidate is the beneficial owner.
The mechanics of this rule prevent the practice of front-running.
Yes. If an analyst conducts research and determines that a specific asset is significantly undervalued, they are ethically prohibited from buying that asset for their personal portfolio before they execute trades for their clients.
Because if they buy it for themselves first and then issue a massive buy order for their institutional clients, the influx of client capital will drive the price of the asset up.
Yeah.
That artificially inflates the value of the analyst's personal portfolio.
They would literally be using their clients' money to generate a personal risk-free return.
The standard dictates a strict sequence. The client eats first, the employer eats second, and the individual professional eats last.
That's the ethical order of operations. We have spent considerable time mapping out this invisible architecture, the aspirational philosophy of the code, and the rigid, granular mechanics of the standards governing everything from market manipulation to record retention. But a framework without enforcement is merely a suggestion.
True.
The text addresses exactly what happens when the ethical muscle memory fails, detailing the mechanisms the CFA Institute uses to police its members.
This brings us to the Professional Conduct Program, or the PCP. When reviewing the practice problems associated with enforcement, one detail about how these investigations begin is particularly striking. The assumption is usually that enforcement relies on internal mechanisms. A compliance officer flags a suspicious trade, or a client files a formal complaint.
Right.
But the text reveals that inquiries can be initiated based on external public information.
The professional conduct staff can open an inquiry based on regulatory notices, other public sources, or directly in response to information provided by the media. This is a crucial element of the enforcement architecture.
It really is. I was surprised by that. It demonstrates that the Institute actively monitors the public's fear. They don't sit passively waiting for a whistleblower to knock on their door.
No, they don't.
If a financial journalist publishes a heavily researched article exposing questionable accounting practices or conflicted recommendations by a charter holder, the Institute can utilize that reporting to trigger an official investigation.
Once an inquiry is initiated, the text outlines an investigation process designed to be thorough and objective. Importantly, the process may include requesting a written explanation from the member or candidate in question. They are compelled to formally explain their conduct and provide the records supporting their actions.
Because they have to show their math, like we said earlier.
Exactly. If the PCP staff determines that a violation of the code and standards has occurred, they propose a disciplinary sanction.
And if the member disputes the finding or rejects the proposed sanction, the matter escalates to the Disciplinary Review Committee, the DRC. This establishes a structured internal judicial system to weigh the evidence and determine the appropriate consequence, which can range from a private reprimand to the permanent revocation of their charter.
The disciplinary system, the inquiries, the PCP, the DRC, provides the necessary teeth to the framework. It is the safety net that catches the failures. But as we synthesize the entirety of this deep dive, it is vital to return to the text's central thesis regarding culture.
Right.
If we connect this to the bigger picture, the disciplinary system is reactive. A healthy, sustainable financial system cannot exist purely on the fear of punishment.
The ultimate responsibility loops back to the beginning of our discussion. The senior management and the firm's culture. Supervisors cannot view their role merely as detecting and preventing violations. The enforcement mechanisms exist for when the culture fails or when a specific individual actively chooses to bypass the guardrails.
But the primary objective is to cultivate an environment where ethical behavior is the internalized default, where that muscle memory is so highly developed that the regulatory boundary is never even approached. The framework demands that professionals look far beyond the minimum requirements of what is legally sufficient.
They must navigate a landscape of extreme complexity, balancing the demands of profit against the mandate of prudence, continually actively seeking what is morally correct and structurally sound. We began this deep dive by comparing the global economy to a skyscraper supported by an invisible architecture of human judgment. By unpacking the CFA Institute's code and standards, the mechanics of that judgment become visible.
You really see the beams and the rivets.
Exactly. We see exactly how principles like total portfolio suitability, the strict separation of fact from opinion, and the uncompromising priority of client transactions function as the load-bearing pillars of the market.
So what does this all mean for the listener?
Well, understanding this framework equips you with the vocabulary to evaluate the institutions handling your wealth. You now understand the precise difference between a professional who is merely following the speed limit to avoid a ticket and one who is actively navigating the road with care.
But the text leaves us with a compelling final thought regarding the evolution of the market. The standards have been updated for 60 years to address new technologies and new instruments. We are now entering an era where artificial intelligence, algorithmic models, and automated systems are responsible for an increasingly massive volume of market analysis and investment recommendations.
Which raises an incredible, provocative question to lead you with. If the foundation of the market relies heavily on ethical muscle memory and the human capacity to apply situational judgment over rigid rules, how do you program that into a machine?
Can an algorithm truly be taught to distinguish between a fact and a forward-looking opinion in a nuanced, volatile market?
And more profoundly, when faced with an unprecedented scenario, can a machine calculate the moral difference between what is merely legally sufficient and what is actually right? When the invisible architecture of finance shifts from human judgment to artificial calculation, how do we ensure the foundation still holds? It is something to consider the next time you look at your portfolio. Thank you for joining us on this deep dive.